Well, markets are closed this morning. Of course, you know, if you don't keep up on the news, you don't remember these things. For the 25 plus years, I still don't remember that markets are closed on April 2nd. But you lose track of time. What can you do? I told everybody that I would definitely look at the charts, or not the charts, but the statements. There's one statement that we look at. It's one of the smaller accounts that we manage. I try to get this through to people's heads that this particular, we're going to go down through basically your percentage gains and your unrealized and your realized, unrealized gains and your realized gains. So what we're going to focus on first is realized gains. People get the two confused. It's interesting because you can have a portfolio that is gaining in value, but if you're not taking any profit, then it's unrealized. So it's important to remember taking profit is important no matter what portfolio you have, because you do have swings in markets. Markets just don't go, straight up. They kind of do this, all over the place. I mean, you can draw whatever you want, and this is what it looks like. But trying to catch tops and bottoms are hard to do, and you can spend a lot of time chasing a number. But what we're going to focus on is how you can monitor what you're actually making in the market versus what an unrealized gain looks like versus a realized gain. So when we look at a unrealized gain, that would be from $26,339 to $27,013. So we're looking at this number here and this number here. So it gains $673.53. That's unrealized, right? So how do we break that down? So that was a 2.56% gain. So it's important to realize that within that you have a gain, an unrealized gain, and realized gains. So how do you break that down? Well, you can go down here to your dividends, right? And then you have your realized, right? And each statement's going to look different from each brokerage, but you want to look at it. We're not worried about unrealized because we don't really pay attention to it. It's just a number until actually it becomes realized. So if you have a realized loss, then it subtracts from your unrealized column. So it's all in accounting. So, and when you see negative numbers here, you have what's called first in, first out. It's not actually a loss. It's just the way they do their accounting. So don't worry about those numbers. But what we're focusing on is this number down here. What did you actually make, right? So if we go back up here to the top, we see total. Okay. So the total gain was $356.76. So if we write that down, it's easier for me to just keep track of it on a piece of paper here. $351.76. All of this over here, don't even worry about it. We're not concerned with that. That's unrealized. That can be like that for a lifetime. And it's constantly changing with market conditions. If the market goes up, this value can go down. If it's negative, if it's positive and the market goes down, it can go the other way. So we're trying to stay focused on those two numbers. So if we take that 351.76, right, we'll just do it as cleanly as we can here. 351. Oops, I'm trying to do this with a mouse. I need a pen. Anyways, and then add that to your dividend amount of $116.39. Let me get the calculator out here so I don't make any mistakes. So 351 76 plus the 116.39, that comes to 468.15. Okay, well, that's realized because something actually happened, right? Put that calculator over here so you can see it. Okay, so you see that number. Now, why is that different from this number? Right, because the actual gain of the account, all right, is this number here. It's unrealized, but within that you have your realized gain. So the difference was the move, right, and all the other stocks that didn't do anything. The overall stock appreciated that difference, right? The overall account moves 673.53. But what you actually made, dividends and trades, was this amount right here. So if we take that and we want to look at the percentage gain on the account, I'll back it up here first. So unrealized, we're taking this 26, right? Because this is what we started with, and we gained this amount to come up with this amount. So we want to find that percentage gain. It should come up to 2.56, right? So we take 673.53 divided by the 26,339.48, right? All you had to do is multiply that number by 100. That's going to give you your percentage. So 2.557, right? Or 2.56 rounded up. Just take that number. What we want to know, because part of that is just floating. It hasn't been realized. What we want to know is our actual gain. Okay? So we take this number here, right, of 468.15, and we divide it by that original number of 26,339.48. Multiply that by 100. So we got 1.78. Okay? 1.78%. And that's in 1 month, right? So if you want to know what you can average for the year, all you have to do is multiply this by 1.78 multiplied by 12 months. Okay, so that comes to 21.36%. You follow your rules. Now this is on a very small account. You're saying there's no way you can make 21%. Okay, if you this is gains on trading, right? Because we've taken no losses. This is gains on dividends. So if we want to back it up a little bit, let me bring it down here, right across here. We'll break it down even further. Let's just say that the market was in free fall and you're not trading, you're not selling anything. So we take that 116.39, divide that by the original 26,000 because your account size didn't grow, right? Let's just say we didn't make any trades. 339.48. Multiply that by 100 to get your percentage. So you got basically 0.44%. We're going to multiply that by 12. So you're going to make 5.3% in dividends. Now you could break that down in your account and look at it. Okay, and everybody poo-poos that. And it's like, okay, so you're still going to make 5.33% if nothing, or 5.3% if you do nothing. So let's take a look. So 116.39. If nothing changes, you don't buy or sell anything. You just keep what's in your account. All of these that are still in your account, you're going to make 5.3% on your money. Okay? Of course, at the end of the year, you got to pay your taxes. But so this value is going to grow each month based on this amount of money, or 116.39, if it stays consistent. We're just trying to say it's staying consistent. It's going to constantly change. But where the power of this comes in is when you start trading it. Okay, you take that 351 and now you know this is 12 months, so nobody's confused. All right? So you know all you have to do is subtract that 5.3 from the 21, and that's going to give you this 351.76. That's the percentage that you're going to make when you're in and out of your trades. This is important to understand because most people, what do? They're collecting this value right here. Doesn't matter the account size, right? What we're doing is we're showing you what you can do with a small amount of money and how you can grow it. If you're just happy with collecting 5.3%, that means you're not going to trade it. All you're doing is putting money into your account and letting it grow. Now, there's nothing wrong with that. But would you rather have this 5.3% or this 21.36? Let me change this color here. Go to a blue. Okay. The 21, if you take, let's say 468, I like working with numbers, as you can probably tell. If we take this 468 and let's just say you're consistently trading it and making that same amount of money on that money, right? Now you know we're just going to use round numbers. This value is going to go up, right, by $468 next month, right? And whatever the market moves is going to be that difference. So we're like, okay, let's just say at the end of the year we want multiplied by 12 months. Get the calculator again. So 468.15 by 12 is 5,617. What did I say? Oh, 5,000. Get the eraser out there. Draw. There we go. So 5,000. Bear with me. This thing is hard to use. 5, 6, and 80 cents. Okay. So that represents this value right here. 21.36%. That's if it's consistent. Now, you can't, guarantee that return. Obviously, market conditions, up and down, everything else. But what I'm saying is if you understand this concept that just throwing your money in the market and letting it sit right there, hey, there's nothing wrong with 5.3, but why not manage the account yourself and make 21, or whatever. Maybe it's 15, maybe it's 30, I don't know. Maybe you just got, a decent deal on some stocks and you're just hitting, and there's lots of volatility. The more volatility, the more you can make. Just as a note, this is approximately what Warren Buffett makes on his portfolios every year. Consistently. Up or down, doesn't matter. This is a numbers game. You can't get tied up in the news. You can't sit there and think, oh yeah, I've got an awesome way to do this. Now, look, 20% on an account that only has 26,000, it's going to grow at a very rapid rate, right? The snowballing effect. Because now this value, you're adding to this value, right? That 26,000 is growing. Let me bring that down. This isn't staying static. It's growing. It's compounding. And you watch this for any amount of time. I mean, you can go back. I have a video. So if this increased by, well, I'd have to go back and look at it. But there's an old video from last month when we did it on this exact same account. You can see the growth. You just go back into one of my old videos. You can probably find it somewhere in there. I'll try to link it if I can. So the whole idea is to constantly take profit. Take money out of the market. Don't be, happy with just this. You can do this for a very short period of time per day, just to look at your account. Now you're, managing your own money. I don't know anybody that wants to, give away 15% of their gain, because that particular amount of money right there, if you go to a brokerage firm, this is what they're going to charge you, right? 15%. Plus, on top of that, anywhere from, depending on the size of the account, 1 to 2% of the entire portfolio. So 2% of 26,000 plus 15% of your gain. And what do? They're managing your money. Well, this is how much you can save right here. You can save from 15 to 17%. I say, well, I don't know how to do that. Well, I'm trying to show you guys how to do this. The more you know, the better off you're going to be, and the better it's going to be for you to trade your money in the future by growing it. But because it's a day off, I'll go into a little bit. I like to keep these, where are we at here time-wise? Oh, we're going to get 16 minutes in. But if you have questions about this, just ask. You can always hit me up at T1 Recon Rider at Dividend Collection Team, or vice versa, whatever it is. But just it's pretty simple and straightforward. But let's just take a look here. One other thing. So we know that this value right here, 673.53, that's the overall account increase, right, since February 28th. Okay, 1 month, $673. So we know that's a 2.56% gain, right, on this amount here. So what we're going to do is, real short, just tell you what the unrealized. So you got 673.53 minus your realized gain, which was 468.15. Right? Get the old handy dandy calculator at 673.53 plus 468.15. Oh, supposed to be minus, say, 468.15 minus 9. Oh, doesn't want to do it. Minus 468.15. So your actual unrealized gain was 205, right? Because you didn't actually capture that. It's just sitting there. It's telling you, if you go into your portfolio, right? We can look at it. Let's see. I think it might be this account. You can go into your portfolio and look. So 27,203. We come back over here. 27. Well, that's the statement date, from March 31st, because it's changed a little bit in the last 2 days. So we're just saying it's pretty close. But you can look at it and say, okay, you could sell something, right? And say, oh, here's a 22% gain. Well, that makes up part of that value in the increase. So we'll go going down a rabbit hole here, but the whole idea is this is going to constantly change. If you sell something, this value goes down, right? If the market goes down, this value goes down. Market goes up, this goes up. It all depends on each individual stock. So that's important to understand. So we'll go on to something else here, because where is it at? Okay, here's our scan from last week, because it's only good till Friday if we had a full week. And these are our CEFs that come up on the scan. So you can see there's, if you look down through here, you can identify some of them, like, let's see if Bit's in here. Bit's not in that particular account. DSL, you see it right there. Sorry, you get some pups playing in the background here. EBV's not on this account. GHY, okay, right there. LDP. You can see what these percentages are, right? Small sums of money, you can tell, right? But if you look across here, we'll just use LDP, right? And we look across here, we have an unrealized profit of 68 cents, right? So that's positive. And then you have, let's look at another one. Main in this account, no. LTC, not in this one. NBB, okay, NBB right here. We'll look at NBB. Let's see, so it's showing a short-term, right, unrealized loss. Short-term profit, okay, so that one actually is profitable, and this is negative, right? So loss, profit. So you see which ones are above water. You could actually close that out, and that would be a positive to your account balance, and it would subtract from your unrealized. This is all accounting. Don't make it too difficult. Don't read into it too much. So you just like, okay, that's the negative. So you see this one up here, Murphy Oil. We're down $5.95. That's just a unrealized. It's not realized, right? When it becomes realized, it comes over to this column. This is just floating around. It can do this for the rest of its life, but if it's paying me dividends, guess what? We don't care. So let's go over, we got our full sheet here. We can see we've got 2 down all the way to 110, so that's 109 different stocks. You can say yellow blocks are not available under 100K in your account. I'm trying to teach this as fast as I can. I've got to get a book together so that everybody can understand how to manage your money. And then you can pick from these stocks what you want. I'll never tell you what to do, but this scan points to the stocks that are more favorable. We use a proprietary way of doing things. It's an easy way to put it. You can see we own quite a few of these. Anything that's colored, we own. There might be a few on there, but today's Friday, so we don't mind. This can change and will change and it comes out on Sundays. You can look back and see, or look back at old videos and see what we traded. You can go down. It gets pretty complex when you start looking at each individual one, but let's see what else is on here. I don't see TSN on there. I'm trying to find one that's on here that maybe bought this week. It's hard to keep track when you do hundreds, per day. RS. Yeah, there's RS. Right. And we look at it, say, okay, so we actually sold that, right? Because it was realized, and you see the profit right there, $2.80. So for you folks out there that think, like this one, 129, right? So that was MPLX. That was earlier in the month. But that's one that we held for some time. Still positive, right? But this, when you see this long-term loss, this is just for accounting purposes. That's not actually a loss. It has to do with how many shares you bought and where you were. When you're doing dollar cost averaging, something that's above, they're going to treat each individual trade differently. It's all in accounting. If you want to get in depth with it, that's fine. You can look more into it, but the overall thing is a take home of 129.47, no loss. That's what we're after. So understanding that you can make money with small trades, right, is going to help you achieve your goals. If you want to make money in the stock market, the best way to do it. Well, this one here, this actually changed and went out of business or something. I don't know. I just noticed that. But it's still, we still have positive, right? We didn't sell it. That was some type of corporate action because we never take a loss. This is what I'm saying. We're not losing. We're constantly winning. You just add them up. And then short-term profits versus short-term loss versus long-term profit. Notice you don't see too many long-term profits in there. So we had 23. What was the other one? Oh, $9 up here. So this one had been in the account for a while. That's short-term. It had been in the account a very short period of time. I think it's 6 months. Maybe it's a year. I think it's a year. Still positive, right? But that's what we're targeting. If you look at it, the number of shares that we owned is going to be a direct, divide that into that, and that's what the dividend amount for the year would be. So pretty straightforward. And each account, you can see the date here. This was done today, April 2nd. We could go down through 14 or 15 different accounts and show you this exact same thing. Okay, it's all done the same way. So positive, positive, positive. If you get this down, you won't trade any other way. But I hope this helps. Like I say, the scans come out. The scans basically just help you, identify those stocks that are in a position, to do better things, to make your profit, maybe move up. There's no guarantees in this game. It's managing money. But like I say, I guess we'll get back with everybody on Monday. We're coming up on 30 minutes for this video. If you have any questions, feel free to ask me. Guess we'll see you in the room. Get this stuff down. It's important. This is where you're going to make your money in the market. You're not going to make your money, trading unless you devote full time. Majority of folks out there are just looking for a better way to invest. Do it yourself. It's important. Watch it, learn it. And one thing, if you're in debt, get out of debt first. This will always be here. This system will always be here. No FOMO, fear of missing out. How you're going to miss out is when you're paying this percentage on your credit card, they're going to wipe you out faster than you can make the money. You want to be bringing this money in. That's the key. But that's it for now. Hopefully you had a good weekend. We'll talk to you later.